What is up, my dick lickers and butt pickers? Welcome back to Trades and Gains, and I have an update for you on the American Dream 2025 edition. You want to buy a home, but mortgage rates are still stuck over 6%. Prices are near record highs, and what's the hot new trend? Well, adjustable mortgage rates, or as you know them, ARMs, are back. The same thing that helped tank the economy in 2008 is suddenly sexy like Paris Hilton again. It's like seeing parachute pants make a comeback and thinking, hey, maybe this time they'll be stylish. Or seeing guys wear skinny jeans again and thinking, hey, they must get tons of girls. And on the other side, while buyers are sitting on the sidelines like kids waiting for Santa saying, wake me up when rates hit 5%. Spoiler alert, that's not coming anytime soon, unless we all get a recession for Christmas, a nice little end of year gift. So ARMs now make up almost 13% of all new mortgages, the highest since the financial crisis. Now, why is this happening? They're cheaper for now. A 30-year fixed rate is currently at 6.35%. A 7-year ARM is 5.78%. Translation, people are literally rolling the dice on where rates will be in 2032. And this is what's currently passing for strategy in today's market. Well, I can't afford a fixed rate, but maybe in 7 years, Jerome Powell will have a heart attack and rates will drop. Or whoever Trump hires after Jerome retires will make rates drop. Who knows? Now, everybody remembers ARMs from the financial crisis. They were like cocaine in the housing market, quick, addictive, and eventually, well, they left you homeless like bubbles in the wire. Back then, teaser rates lasted 2 years before exploding. People woke up one morning and their mortgage had tripled. That was less home ownership and more foreclosure speed dating, because you had strippers out there buying houses with cash, okay? Let's just keep that out there. But today's ARMs are different. Stricter standards, bigger down payments, caps on how high rates can jump. In other words, it's like putting a warning label on cigarettes. Technically, they're safer. It still kills you, even if you're unlucky, though. So it's like, hey, we warned you, but you still may be getting bent over the barrel here, Karen. Meanwhile, the rest of the market is in wait for 5% mode right now. Surveys show buyers want to see mortgage rates at 5.5% before they jump back in. Oh, that's adorable, babes. Oh, you wanted to go back to 5.5%. Well, I highly doubt that's going to happen. Experts are saying we probably won't see 5% until inflation is crushed. And you see how that's been going. The Fed unwinds rates and long-term yields normalize, which could take years, or the faster way, we could just go into a recession. Yeah, that might be the best thing. Oh. Yes, folks, the fastest path to 5% mortgage is mass unemployment. Great trade-off. Honey, we lost our jobs, but look, we can finally afford a 2-bedroom in Jersey. Let's go. Atlantic City, here we come. Now, here's the reality. The Fed cut rates last week. What happened? Well, mortgage rates went up again. Oh, who saw that coming? I told you guys that was going to happen. Jesus. Watch my videos. Why? Because the 10-year Treasury yields popped. Mortgage rates aren't tied to Fed cuts in a neat, clean way. They move on bond markets, baby. Inflation expectations, and, well, just overall investor vibes, which suck, by the way. So, like, good luck using that last thing as a way, Wait. So currently, if you're going to wait for 5% rates, that's pretty much like waiting for your ex to text back. Sure, it could happen, but you'll be old, bitter, and living with roommates by then. And also, she'll just text you to dump her trauma about how some new guy she started dating love bombed her and then left her stranded in Arizona. So you might have to deal with that too, which is, by the way, super annoying. Don't answer those calls because they'll just talk about themselves for like 2 hours and how horrible their lives are while completely neglecting you. So, yeah. Anyways, meanwhile, ARMs are basically people saying, if I gamble my financial future, I'll gamble my financial future so I can buy granite countertops today. Now, here's the choice for the American home buyers right now. Take the ARM. Save a few $100 a month today. Risk crying into your adjustable payment later. Yeah, that's the gamble there, folks. Or you could wait for 5%. Sit on the sidelines, hope for a recession, and pray you still have a job when rates finally do fall. Because guess what? When rates do fall, you will probably be out of work. Neither is exactly the American dream. It's more like the American compromise. Do you want instant stability now, or do you want to be disappointed later? Do you want your dad to actually come back with the milk, or do you want him to just tell you he's going out for cigarettes and then you just kind of hope he comes back at some point? But guess what? There's a kicker. Even if rates do drop, guess what? Competition's going to skyrocket. Yes, you guessed it right. More buyers flood in and, well, prices pop again, and then all of a sudden you are priced out of a home again. And you're right back in the same position except with your 5% rate. So yes, ARMs are back. Buyers are waiting for 5%. And the housing market is once again America's favorite casino. The lesson: don't buy a house you can't afford. Don't bank your future on Fed fairy tales. And for God's sake, don't say, this time ARMs are safe. That's like saying, this time the Kardashians are going to be classy. Bottom line, if you're holding out for the perfect mortgage, you'll be holding out forever. In today's market, the only thing fixed is your disappointment and the fact that you'll probably get a divorce if you don't buy that house. Anyways, that's your mid-morning, mid-afternoon mortgage breakdown. If you haven't already, make sure you like, subscribe, leave a comment of what your current mortgage rate is so I can roast you in the comments, you loser. Anyways, have a great weekend. I'm going to go gamble on some football.